Welcome to Buy, Hold, Sell, and today's special edition I'm joined by Campbell Dawson from Elstree and John Abernethy from Clime. Today we're going to talk about where the share market's at. We're up 10% since January 1, so that's in less than 3 months, and since June 4 last year the market's risen an astounding 28%. So for mums and dads who are long the share market now, they should be looking to sell in the next few months?
I think lightening off, some of your positions that you're less comfortable with, would be a good idea.
John, do you have a contrary view? I know you said the market should hold about here, but do we have the volatility that Campbell's talking
Well,
about?
certainly if it rallies, I'd be raising cash levels as a fund manager. Okay, so if you're fairly fully invested now, you'd certainly be raising cash into a rally towards 5.5. It should be around current levels at the end of the year. That's the problem. Yep. And the market won't sit still. So get ready for some volatility.
So the stronger it is at the moment, the more cash you should raise. That's the message.
Yeah.
So John, a lot of people have missed this rally of 28% since June. They've got a lot of money in the bank or in their cash management trusts. What do you think they should do now?
Well, not be greedy. I mean, greed's a terrible thing. So take your time, at least select some stocks. I certainly wouldn't be buying the market. I'd really go into stock selection again. So we said earlier about the banks. I think the banks are okay at current levels and the yield is okay. Telstra's of the world, I'd be more yield focused and sustainable yield at that. I wouldn't be trying to buy growth which doesn't exist.
So stock like Telstra or the banks that are yielding between 5 and 6% fully franked will hold their share price, and it's better than getting 3 or 4% in the bank.
Yep.
Campbell, have you got a view on that?
I tend to agree. Like, cash has been the best investment for the past 5 years and people are overweighted structurally, so but at the same time they shouldn't be jumping into market feet first. And I suspect we start to see people talking about rate rises next year too.
So if you're in the share market, stocks that are more defensive that can hold their yield, is that what you're feeling?
I think so, particularly when cash rates are at 3. So all these banks on yields of 6 and 7 aren't going to go too far south, even if they are overvalued.